If markets were truly normal, 2008 should have never have happened. Not once in your lifetime, not once in human history, yet it did. And this wasn't the only so-called once-in-a-lifetime market crash we experienced. So either markets are broken, or most investors fundamentally misunderstand statistics. Hi guys, I'm Lewis. Welcome to Investing Canvas. Today we're talking about something that sits underneath everything in investing. That's statistics, probability, and mathematics. Because investing isn't really about prediction, it's about managing uncertainty, and uncertainty is a maths problem. Most people approach investing like it's forecasting. They ask, where's the market going to be next month? Is the stock about to break out? Is recession coming? But markets don't operate in certainties, they operate in probabilities. Every investment has a range of possible outcomes, a distribution of returns, not a guaranteed path. If you don't think probabilistically, you'll constantly feel surprised, and surprise leads to emotion, and emotion leads to mistakes. The goal isn't to eliminate uncertainty. That's impossible. The goal is to structure decisions so that probabilities work in our favor over a long enough time horizon. To understand that properly, we need to zoom out. One of the most influential ideas in finance is the efficient market hypothesis. In simple terms, it says that prices reflect all available information. If that's even partially true, then consistently outperforming the market becomes very, very difficult because any obvious opportunity gets priced in almost immediately. And closely related is the random walk theory, which suggests that short-term price movements are largely unpredictable, not because markets are irrational, but because new information arrives randomly. And if new information is random, then short-term price changes must be random too. This is why reacting emotionally to daily price moves is usually pointless. You're reacting to noise, not signal. But here's where things get more interesting. In school, we're taught to think in terms of normal distribution. We've all seen it, the classic bell curve. Symmetrical, orderly, predictable. Under this framework, extreme events are incredibly rare, but financial markets do not behave like textbook bell curves. Market returns are often non-Gaussian, fat-tailed, and what statisticians call leptokurtosis, which simply means extreme events happen more frequently than a normal distribution would predict. In a perfectly normal world, a 5 standard deviation crash should happen maybe once in every several thousand years. In financial markets, we've seen multiple once-in-a-lifetime events occur in just a few decades. This tells us something critical. Risk is underestimated if you assume normality. Markets have fat tails, and if your strategy assumes smooth volatility and tidy distributions, eventually you will encounter something that you didn't model. That's why risk management matters more than return forecasting. Let me simplify all of this in a framework that may resonate. Think about the casino. The casino doesn't win every hand. It doesn't predict every spin on the wheel, but it has a small statistical edge, and it repeats over thousands and thousands of times. Over time, maths works in its favor. That's the expected value. You don't need to be right every time. You just need a process with a positive expected value repeated consistently. Most investors don't fail because they're not intelligent. They fail because they don't truly understand the probability behind the markets. This is where the law of large numbers becomes incredibly powerful. It tells us as the number of trials increases, outcomes converge towards their expected value. In investing terms, 1 year tells us very little, 5 years tells you a little bit more, and 20 years tells you a whole lot. Short-term returns are noisy, long-term returns tend to reflect underlying probabilities, but only if you survive long enough. And survival requires diversification, proper position sizing, avoiding excessive leverage, and avoiding forced selling. You have to stay in the game long enough for the maths to actually play out in your favor. There's also an interesting tension worth thinking about. If markets are efficient and short-term movements resemble a random walk, why do factors like momentum and mean reversion show up repeatedly across decades and across different countries? That's where systematic investing comes in. I'm not trying to predict the future. I'm trying to build a structured process that respects market efficiency, accounts for fat tails, and incorporates observable statistical tendencies and manages downside risk. I don't assume I know what's happening next. I assume uncertainty and I design around that uncertainty. If you take nothing else from this video, remember this. The market doesn't reward certainty. It rewards discipline under uncertainty. If you treat investing like prediction, you'll feel anxiety. If you treat it like probability, you'll feel patience. And patience combined with sound mathematics and structured risk management is where compounding truly lives. That's the foundation of everything we build at Investing Canvas. Thanks for watching, and I'll see you on the next one.